Okay, I'm going back to recording on this thing now. Let's take a look at the. I won't play the video, right? And just in case that had something to do with things conking out, I doubt it. There've been Zoom problems, by the way. It was down for a few days earlier in the week, and I thought it would be fixed by the time we used it. But let's take a look at the homework for this, right? Right now, they were taking you through treasury stock. That was about as far as we got. So if we go to brief exercise 10-8, let me read it to you. On March 15th, American Eagle declares a quarterly cash dip. No, wrong one, sorry. Brief exercise 8, which is on page 523. California Surf Clothing Company issues 1,000 shares of $1 par value common stock at $35 a share. Later in the year, the company decides to purchase 100 shares at a cost of $38 a share. Record the purchase of the treasury stock. So, you know, again, typical of accounting problems, they give you more information than you need. Telling you that the stock was originally sold for $35 a share doesn't really mean anything in this case, right? We're concerned with the repurchase of the stock at 38. So debit treasury stock, 100 times 38 is 3,800, and credit cash. All right, it's a pretty simple transaction. Debit treasury stock, credit cash. The cost of the treasury stock account is $38 a share now. So if later we want to sell some of that stock, $38 a share is the baseline, right? That is how much we paid for that stock. We will debit or credit that account for $38, which takes us to the next exercise, number 9, brief exercise 9. Refer to the situation described in brief exercise 8. Record the transaction if California Surf resells the 100 shares of treasury stock at 40. So they bought it at 38 and they're reselling it at 40. Debit cash 100 times 40 is 4,000. Credit treasury stock at the cost of 38, 100 times 38, 3,800. And now you've got a $200 extra credit, right? That goes to additional paid in capital. You can calculate the amount. It's 100 times 2. Right, so that's treasury stock. That's really all we need to know about treasury stock. If you take intermediate accounting, you get into a little more detail with it. You'll see that there's another method. There are 2 methods of accounting for treasury stock. The cost method, which this is, and then there's another method called the par value method. But this is all we have to know for our class. The other thing to keep in mind, sometimes when you do problems, right, they'll take you through a bunch of transactions, issuing shares and buying treasury stock and reissuing treasury stock, and then they'll say, pay a dividend. So remember, you need to keep track of the number of outstanding shares in order to know how many shares get the dividend. Now, I don't know if we're going to see that, but that's usually what makes these problems more challenging. Now, the next topic was dividends. Dividends. What are dividends again? Well, the company likes to reward the stockholders by paying them something. You see, if you put your money in the bank, you would get interest. right? And everybody likes to get interest. So what about if you invest money in stock? Well, some companies like to reward you by paying you a dividend. Now, where do dividends really come from? How are they made? Well, you have to have profits in order to have dividends. So dividends get paid out of retained earnings. That's the account where all the accumulated profit of a company, where it sits. And then if we decide to share some of that profit with the stockholders, it comes out of dividends. And if you remember from last semester, chapter 3, when you go through the closing cycle, the closing entries, one of the closing entries is to close the dividends account by debiting retained earnings. So eventually, dividends wind up reducing retained earnings. So how do we record dividend transactions? Well, the first thing is, like I said earlier, dividends is not automatic. The board of directors has to have a meeting and decide to have a dividend. And then usually they have a press release, and in the press release, they'll tell you about the dividend. The date of that press release is the declaration date. So that's the date that the board of directors tells the world that you're going to have a dividend and how much. So if we look at brief exercise number 10, which is on page 523 in the text, it says Divine Apparel, that's the name of the company, has 4,000 shares of common stock outstanding. On October 1st, the company declares a 75-cent per share dividend to stockholders of record on October 15th. The dividend is paid on October 31st. Record all transactions on the appropriate dates for the cash dividend. So the first date they mentioned there is October 1st. That's the day the company declares the dividend. 4,000 times 75 cents a share is $3,000. Debit dividends, $3,000. Credit, dividends payable, right? Liability, dividends payable, $3,000. On October 1st, I owe my stockholders $3,000. Now, earlier in the chapter, they talked about stockholder rights and how dividends are a stockholder's right. Well, once the dividend is declared, then you have a right to receive it. The day that liability is created, the company is obligated to pay it to you. The company doesn't have to pay a dividend. So if they get together and say, you know what, things are not going so great, we're not going to pay a dividend this quarter, they don't have to. And you don't have a right to receive it since it hasn't been declared, right? But now that it's declared, it must be paid, because otherwise they are in default. And just like any other liability that you default on, that is not a good thing to have happen. Now, the next date to keep in mind there is October 15th. October 15th here was referred to as the record date. They're going to pay the dividend to all stockholders of record on October 15th. So for you to receive that dividend, you have to have owned that stock on October 15th. And on October 15th, the company will make a list of who they're going to pay the dividend to. So that's known as the record date. No journal entry required. Just make a list of who will get the dividend. And then finally, October 31st is the day the dividend gets paid out. Debit dividends payable and credit cash, just like you would debit accounts payable and credit cash, right? Debit dividends payable and credit cash. Now you know who you're going to pay the dividend to, so you can actually write the checks. You see, on October 1st, you're not sure who you're going to pay it to. You have to wait until October 15th before you'll know that. And then October 31st, you're actually going to write the checks for $3,000 to pay the dividend. All right, so that's treasury stock and dividends. Okay, now let's see. We had another video, but I'm not going to play it because of the problems that we were having. I'm in a strange place, so my internet connection might not be the greatest either. So let's take a look at problem 10-4A. Now, this problem, the best place to look, problem 10-4A, is on page 530 in the book. Let me see. Let me pull it up. Just so we can see it, look at it together. All right, now again, this is a problem that some people have problems with. All right, so let's take a good look at it. I think there's a test question on this. And there might also be an extra credit problem on it too. I don't remember off the top of my head.
Professor,
Yes.
is this the homework that was already due?
No, this isn't due till the 25th,
Okay, this is okay.
right? This is the next chapter. The homework that was already due was chapter 9. This is 10. Okay, so here's the problem. Right now, let's just take a look at this. This is a stockholders' equity section of a balance sheet. So notice you have primarily two sections, actually three, right? If you want to look at it that way. It's divided into three sections. You've got a paid-in capital section, a retained earnings section, and a treasury stock section, right? So if you were going to make an outline of stockholders' equity, right, you would divide it into three parts: paid-in capital, retained earnings, and treasury stock. The paid-in capital, another word for that, you might say, is invested capital. How much did the stockholders pay us for their stock? So we've got preferred stock, common stock, and additional paid-in capital, right? Notice par value, and then additional paid-in capital are the amounts above par value. Now, they did something very sneaky here. Ordinarily, the way I like to see this is, yeah, preferred stock, $1 par, that's great. Common stock, $1 par, that's great. But additional paid-in capital, they played a dirty trick on you. They combined the preferred and the common together to make up this number here, 1,164,000. So that's going to create a problem for us later on. It's not a problem that's insolvable, but it's just something that complicates things. So total paid-in capital, 1,200,000. What does that mean? That our stockholders gave us $1,200,000 in exchange for their stock. And a certain amount of that came from the preferred, and a certain amount of it came from the common. And I think there's a question here that's going to ask us to sort that out. Retained earnings, $288,000. So this company has had profits in the past, right? For that number to be there, that means they have to have had net income. And they probably did pay dividends out at some point. So this is how much remains, right? Remember, retained earnings. The word retain means to keep, and the word earnings means net income. How much net income does the company keep? It keeps it all minus what it paid out in dividends. And they had treasury stock. They bought back 11,000 shares of stock, and they paid a total of $352,000 to do that. And notice how that number gets subtracted because treasury stock is a contra stockholders' equity account. So all these accounts that you see here, all these numbers that are positive, these are credit balances, right? All these accounts have credit balances, except this guy, he or she has a debit balance of $352,000. So we wind up with total of $1,136,000. Okay, now, based on this, let's answer these questions. How many shares of preferred stock have been issued? How many shares of common stock have been issued? Now, the reason I mention them both together is that the calculation is the same, right? And if we go back up here and look, this number here is 6,000. That's 6,000 total. The par value is $1 for one share. 6,000 divided by 1 is 6,000, right? So there are 6,000 shares outstanding, issued. 30,000 divided by 1 is 30,000 shares issued. So where's the, right, here we go. Shares of preferred stock issued, 6,000 divided by 1, 6,000. Shares of common stock issued, 30,000 divided by 1, 30,000, right? That was easy, right? Now comes the tough stuff. Look what they tell you here. If the common shares were issued at 30, what is the average price per share that the preferred was issued at? Right? Now, when you first look at that, you say, I'll never be able to figure that out, right? Because, why? Because these yo-yos put the additional paid-in capital for both the preferred and common here in one number. We need to separate that. We need to separate that into two piles, a preferred pile and a common pile, right? So let's see how we do that. If common was issued at 30, what was preferred issued at? Well, if the common stock was issued at 30,000 shares times $30 a share is 900,000. 30,000 of that is at par value. So how much was above par? 900 minus 30 is 870. So if you go back to this 1,164,000, right? Some of that's preferred and some of that's common. How much of it is common? 870. So 1,164,000 minus the common 870, that gives you preferred. The preferred is 294. Now that's just the additional paid-in capital. If we add the par value, 6,000 plus 294, that's a total of 300,000. And if I issued 6,000 shares of preferred stock, 300,000 divided by 6,000 is equal to $5 per share. So the preferred stock was issued at $5 a share. The common was issued at 30. The preferred was issued at 5. Right? So that was kind of a sneaky, dirty trick they played on you there. But it, you know, you could figure it out. Okay, here we go. If retained earnings at the beginning of the period was $250 and 30 million was paid in dividends during the year, what was the net income for the year? Now, if you like to draw T accounts, right, you could draw a T account, and for retained earnings, and you would say beginning balance was $250, that's on the credit side, and then 30 million dividends, that's on the debit side. And then what's the ending balance of retained earnings? It was 288. So the number that balances that account is the net income, right? Which is here. So if the beginning balance is 250 and we paid out a dividend of 30, 250 minus 30 is 220. What does net income have to be if the ending balance is 288? 250 plus 68 minus 30 is 288. So net income is 68. Okay, and this one's pretty easy, I think. What's the average cost per share of the treasury stock acquired? Well, it's 352 divided by 11. 352,000 divided by 11. I bought 11,000 shares. I paid a total of 352,000. What was the average price per share that I paid to buy it back? So 352 divided by 11 is $32 a share. $32 a share. Okay. So that takes us through that. Right? And then there's another problem here, it looks like. 10-6A. 10-6A. Let's take a look at that. Okay. Now, this doesn't look like much, right? I only see a few transactions there, but this is these problems here they can be challenging, and part of the problem is you need to keep track of the shares, because sooner or later what happens is they lure you in, and you can do the entries, and then they say, let's have a dividend. All right, and then what do? You just scratch your head and say, what do I do now? All right, so let's take a look at what this says. Now, what do they want us to do? What are the requirements? Record each of these transactions. In other words, we need to make journal entries for all of these. And then they want us to prepare a stockholders' equity section of the balance sheet at the end of 2021. They tell us net income was 490. That's fine. So what we need to do, I mean, again, in an ideal world, you would draw T accounts for these things. And even though they don't ask you to do it here, how else can you keep track? So you would need to draw T accounts. And if you go back to the beginning, they tell you that the company has Major League Apparel. That's the name of the company. They have two classes of stock. They have preferred and they have common. The preferred has a $1 par value, has a $10 par value. And that 6% means the dividend is going to be 6%. Now you could look at it a few different ways. It's 6% of $10 times the number of shares. Or once we know what the total par value is, we could just multiply that by 6%. So sooner or later, we're probably going to have to deal with that. And we have $1 par value common. Right? So I can almost guarantee you now, what accounts are we going to have? We're going to have a preferred stock account. We're going to have a common stock account. And we'll have additional, I'm sure that we're going to have additional paid-in capital for each. For each. So I would start out, if I was going to draw some T accounts, I would draw 4 accounts: preferred stock, common stock, and then additional paid-in capital preferred and additional paid-in capital common. You are no doubt going to have treasury stock. I would draw a T account for that. And you're no doubt going to have a dividend. I would draw a T account for that. In fact, you might draw 2 T accounts, one for the preferred and one for the common. But I think the way they do the problem here, when you're doing the problem on Connect, it's 1 account. But I think when I go over the answer, I think I break it down into 2. All right, so let's take a look. Now notice you've got issue 110,000 shares of preferred stock at 70. Issue 60,000 shares of preferred stock at 12, right? So let's look at those 2 transactions first. So January 2nd, that was the common stock. Debit cash, 110,000 shares times 70 is 7,700,000. Credit common stock at par, 110,000 shares times $1 is 110,000. And then the difference goes into the additional paid-in capital, right? So you could just say 7,000,007 minus 110,000 is 7,590,000. Or if you're ambitious, you could calculate that number. 110,000 shares times 69. What does the 69 come from? Well, if the stock was sold for 70 and $1 is par, $69 is the amount above par, right? So either way, right, that's how you come up with that. And now you've got the preferred stock is being sold at 12, 60,000 shares times 12 is 720,000 debit cash. Credit preferred stock at par, 60,000 times 10 is 600,000. Credit additional paid-in capital, 60,000 times 2, right? 12 minus 10 is 2, is 120,000. Right, 120,000. So, you know, whether you sell common stock or preferred stock, the entries are very similar, right? Debit cash for what you receive, credit the stock account at par, credit additional paid-in capital for the amounts above par. Now, the next transaction was on May 8th. Purchase 11,000 shares of common stock for 60. That's treasury stock, right? 11,000 times 60. So debit treasury stock, 11,000 times 60 is 660,000. Credit cash, 660,000. So how many shares of stock outstanding do you have right now of common? You have 110 minus 11, right? Minus 11. So that's 99,000, I believe, right? Now what happens? Resell half the treasury stock at 65. 5,500 times 65. So debit cash, 5,500 times 65, 357,500. Credit treasury stock, always at cost. Remember, the cost was 60. 5,500 times 60, 330,000. And the extra $5, additional paid-in capital, 5,500 times 5, 27,500. Now for the dividend. All right, now for the dividend. Declare a cash dividend on the common stock, $25 a share, and $36,000 on the preferred stock. So thank goodness on the preferred stock, they gave us the number. Now, could we have calculated that number? Yeah, I mean, 6% of par value. What's par value on the preferred? If you go back to the first entry that we made, second entry, I'm sorry, 600,000 times 6% is 36,000. So we could have calculated that number, but they had mercy and they gave us that number. So we know that $36,000 is the part of the dividend that goes to the preferred, but what goes to the common? We need to calculate the shares outstanding and then multiply that by 25 cents a share. Right? So let's go over here and we see how to do that. Okay, now I have two debits to dividends. I think when you do this problem in Connect, you just have to give them one number. But I did it as two separate numbers because, you know, you have to see how it works. So we're going to debit dividends. We know part of it is 36,000. That's the preferred portion. What about the common? Well, how many outstanding shares are there? We issued 110,000, and there are still 5,500 shares of treasury stock. So I have to subtract. That gives you 104,500 shares of common times 25 cents is 26,125. right? So debit dividends, again, I did it in two parts. The common part is 26,125. The preferred part is 36,000, and credit dividends payable for the total. For the total. All right, and what else did they say here? So that was December 1st, the day the dividend is declared. The record date is December 15th. We didn't have to do anything for that. Remember, that's the day you just have to make a list. And then you pay the dividend out on December 31st. See, this is a typo here. Oh, pay the cash dividends declared on December 1st. You do that on December 30th. Here we go. So on December 30th, debit dividends payable and credit cash, right? There's your number, 62,125. Now remember the second part of the problem. Now again, you know, class, I'm going through this fast, right? I worked these numbers out already. This is going to take you a little while, right? So don't be impatient. Take your time. Don't get anxious. Don't get upset. This is going to take time. This is not the simplest thing in the world to figure out, right? This is not going to be a 5-minute project. This will probably take you an afternoon, right? So, you know, just prepare for it. So prepare the stockholders' equity section of the balance sheet as of December 31st. Net income was $490. Now, let's see. What did I do here? What I did here is that I looked at the accounts. So we have preferred, that's the par value, right? That was 600,000. The common was 110. The additional paid in capital, what did I have in additional paid in capital? Well, again, go back to the entries. The first one was 7,590,000. The second one was 120. Right? That's where that comes from. And the third one came from the treasury stock, 27,500. So the total additional PIK, right? Paid in capital PIK is 7,737,500. What about retained earnings? Well, the beginning balance was 0. The net income was 490. They gave you that, right? They told you that. And the dividend was 62,125, right? There's a minus sign there because dividends reduces retained earnings. So retained earnings comes out to 427,875. And what about treasury stock? Treasury stock was 660,000 originally, right? Remember, 660. And then we credited it for 330. So what's left in treasury stock? 330. And remember, that's going to be a debit balance. What about shares? 60,000 shares of preferred issued, 110,000 shares of common issued. How many shares of treasury stock are there? Well, there were 11. Then we reissued 5,500. There were 5,500 shares remaining, right? Now, again, you know, the book is not asking you to do this, but how else are you going to come up with the numbers to give them? In other words, they want you to just do this. Well, how do you do that? You just can't create the numbers out of thin air, right? You have to have some way of organizing those numbers. So that's what I did for you here, right? I showed you how to do that. Set it up, make a column for preferred, a column for common, and so on. Also for the shares. All right, so here's what it looks like now. Major League Apparel balance sheet, stockholders equity section, the date. Right now, stockholders equity, we have preferred, we have common, and additional paid in capital. And nice, right? Because we calculated all those numbers, they are right here. Now, again, I don't know how much detail they want you to give when you're doing the problems on Connect. They just may say preferred stock, and they don't tell you the rest of the things, right? But I'm doing this in such a way that you actually learn something from doing it. You're not just trying to fill out boxes. So for preferred stock, what do you have? It's 6% preferred stock. That's the dividend. It has $10 par. There were 60,000 shares issued. There were also 60,000 shares outstanding. There's no treasury stock on the preferred, right? Typically, treasury stock is on common only. For common stock, you have 110,000 shares issued, and there are 104,500 shares outstanding, right? So outstanding means you have to subtract the treasury stock, the treasury shares from the issued shares. So that's where that 104,500 comes from, but the number is 110,000, right? Because the number there represents the issued stock. The additional paid in capital was 7,737,500, which we got here from combining all that. That gives you total paid in capital of 8,447,500. And notice I put here in bold type, this is invested capital. How much did the stockholders pay me for their stock? $8,447,500. Retained earnings is 427,875, right? That's this number here. And less treasury stock, 5,500 shares at cost, 330,000 is a total of $8,545,375. So those are your two homework problems from this section, right? From this part of the class. I think when you go to do the homework, I think when you go on Connect, it's in reverse order. So I think your first question is this one here, right? Remember this one where we had to come up with all these different amounts, right? Problem 10-4. I think this is the first problem you do. And I think this is the second problem that you do, this one, right? And then the others come after. So it's kind of in reverse order. How we doing?
Good.
Okay? You mesmerized?
Yes.
Are you saying to yourself, what did I get myself into?
Yes.
Yes, I know, but you can do it. I know you can do it. You know, print these things out and work with them. Work with the numbers, in the, don't just sit down and try to do the damn thing on the computer. Don't do that, right? Because they're not learning then. Then you're just trying to cram numbers in boxes. Print this stuff out, sit down, you know, with a pencil and a piece of paper, and, you know, try to work the problem out yourself, then go on the computer and try to do it. I know everybody's busy and everybody's impatient and everybody's got a million things to do. Take your time, right? Because otherwise you're going to get frustrated. Everything you need is here. It's available to you, right? I know you can do this, but you just got to take your time and be patient. Does anybody have any questions? You know, you could watch the video again. You may have to watch it 2 or 3 times. Was somebody going to say something?
I just said no to not having any questions.
You know, sometimes you don't know enough to even ask a question, right? I've been there. But, you know, again, that just means you have to roll up your sleeves and get to work. And I know you can do it. I know you can. So if there's no other questions, I suggest that we break now and spend the remaining time we have, about a half hour, working on the problem. And, you know, you've got a solid week and a day before this is due. So you have plenty of time. Don't try to do it all at once. Do it a little bit at a time, and you should be fine. But these two problems that we did here today, these two are the toughest ones, I would say. The other ones aren't that bad. All right, so email me if you have any questions, if you have any issues. Remember, if you want extra help and I'm not doing it for you, you have the Learning Center, right? If you go back to the announcements, where is it? If you go back to the announcements, I give you the email address of, here are the announcements. All right, you have the email address of the Learning Center, Bob Deanna at ncc.edu. All right, tell Bob what you're having a problem with, which particular problem, and they'll work with you. And he'll contact me to let me know if there's something else I should be doing. All right, guys, so have a nice weekend. Weekend's here.
Have a good weekend.
Right?
Have a good
Not
weekend.
too nice, right?
Have a good weekend.
Not too
Good
nice.
weekend, Professor.
We want to make sure you do work. So part of your weekend's not going to be nice, right?
No,
Okay. Be well, and I'll see you next week.
you too,
You said
Professor.
that homework's due
Professor.
next Friday?
Thank you, Professor.
You said that homework's due next Friday?
Next Friday, right? Go on Blackboard. You'll see all your debates.
Thank you.